Oh, no. There's another part. Yeah.
Yeah. Mm-hmm.
Okay. I just wanted to make sure, Nenon, the top
Mm.
part, insurance, am I getting this correct? That this is the understanding that you had, that essentially you pay your premiums, right? And
Mm-hmm.
then the insurance will let you know that, listen, your premiums will grow at, it normally would be 2%. They wouldn't, on cash.
That's a cash. That's a cash
Yes,
value, not a
yes,
cash benefit.
yes, cash value. Let me say cash value.
Mm-hmm.
All right. Essentially, they would say that's at 2%, and then the death
Yeah.
benefit would be what you covered for, right?
Yeah, that's what you. Mm-hmm. Are these rents?
Currency agnostic.
Okay.
But yeah, it's rands. It's supposed to be rands. The only reason I kept it currency agnostic is because on the one hand, you've got the Russian system, on the other, it's the US system,
Mm-hmm.
right?
Mm-hmm. Okay.
Yeah.
Yeah.
And then in the second part, I'm saying with your retirement annuity, right? You would essentially be contributing 24,000, right, per year over the 40 years, right?
Mm-hmm. Mm-hmm.
Compounding at 8%. And that would, okay, now the figures have ballooned. I think it's the extra 10 years. That's actually what the extra, because I think on our call we're working with 30 years.
We're working with a lot of numbers. We
Yeah,
first did 2 million, then we did, yeah.
yeah. What's the error?
That dot in front of C. Mm-hmm.
Actually might be a bit more. Just because the fees will also compound at 2%. So
What are the fees?
the
Fees for
fees,
what?
the fees is basically what they're gonna take as a fee. So your whatever Sanlam or Old Mutual or you name it.
Mm-hmm. Okay.
Yeah. Let me just say because yeah, that's correct. If I compound the 480 at 8% over the years, so I would say the net would be that minus that. I'm saying that's what you're looking at 65. So I'm saying with your insurance, right? You pay your
Mm-hmm.
premiums of 24,000, and over the 40 years, you'll have paid premiums of 960,000, which is the 24,000 times 40, correct?
Mm-hmm.
And then
Mm-hmm.
you saying that essentially the cash value would have a growth rate, and I'm using
Yeah.
2% in this instance to say at any given point in your life, you can withdraw your cash value, which would have been growing at 2%, but limited to your premiums.
Well, okay. But the thing is that you see, the cash value, it's dependent on many factors,
Okay.
right? It can be growing by the policies, guaranteed interest rate, dividends for participating policies, and so on, right?
Yeah.
And I was saying to you during the call that this works, there must be some sort of investment part of the insurance company, because the dividend, I mean, the cash value is working as an equity. So we had an example of buying a house, right?
Yeah.
So like the whole life insurance is working as you buy a house, it appreciates yearly, the cash value is working the same way. Now, we know that death benefit is constant, like throughout the whole time. But what happens if I am taking a part of my cash value accumulation and putting it into my death benefit, and then the rest of it I'm putting it into the investment part of the insurance company, which that is the part that is controlled by the investment company. And it goes back to my question of saying, so what are the advantages of having the RA, whereby all your withdrawals are now, look, you are putting some of the stuff, some of the cash value accumulated funds, some of them into the death benefit. That means the death benefit is growing as well. And you're taking the remains and you're putting them into the investment part of the insurance company, right?
Okay.
So your death benefit is not staying constant, like it's increasing throughout. How many years do we have here? Throughout the 40 years, it's increasing by this portion that you are putting that side. And then the remaining portion is for you, that side.
Okay.
Now,
so are you saying I should do that? Are you saying I should do this?
Yes, because I mean, this is the question I was asking you, because, for example, in Russia, the whole life insurance policies have savings or investment components. And my question to you was, does it work the same way in South Africa? Because if it does, then I'll go back to my point where I say, if you have your RA account and you're making withdrawals whenever, but they're being taxed, why wouldn't the life insurance serve an advantage for you? Because you can simply take the cash you've accumulated in your cash value stuff and be using that to invest in your RA, if you're saying it's a better option, right? To invest in that.
You're saying, why don't I take this portion of your RA? Which one? This one?
That's not the RA. That's your cash value, right? The investment benefit right there is your cash value, right? The remains of it that you've now put. And the other one you put into your death benefit. You are saying that the withdrawals from the RA are not taxed, or are they taxed?
They are taxed. So let me say
pre-taxed. So then why isn't it better for me to, why isn't it better for me to work with the insurance company? Because everything I withdraw up until that part where, and mind you, probably I need this just for retirement, but probably I need it just to pay off my debts, because maybe I have a mortgage loan and so on. So why can't I be withdrawing from the life insurance instead of the RA to settle my debts? And is it possible to withdraw from the RA to settle debts, or that's just a retirement scheme?
As far as I understand, it's a retirement scheme.
Mm-hmm.
Yeah. So
now this retirement scheme of the RA, would it work better than using the life insurance, well, the whole insurance, because that's what we're talking about? Would it work better than the RA for retirement?
If you don't, let me think. Okay, for retirement, so meaning that you're not going to die.
No, isn't it? It's a life cover.
Sorry, yes.
It's a life cover, isn't it? So I don't really know when I'm gonna die, like, right? It's an uncertainty. So let's just say I live up to 75 instead of the 65, but I retire at 60. That means I have 15 years to go through this retirement phase.
Okay.
So I must pay myself and so on and so forth.
Okay. I'm just trying to think how I can model it here on Excel so that I capture your question.
Okay.
Yeah. So you're saying the first scenario is I live up to 75.
Yeah, I live up to 70.
Up to 75. And you're saying in that instance, what you would be doing is in that 15 years, you would be withdrawing your cash value, 979,200. Let's say divide by 15. Right? And then here, that essentially will stay your withdrawals. That's up to 75, right? So here you would say equals that multiplied by about 4 times 15 years, right?
You are dividing 979,000 by 15.
Yes.
For what reason?
To say essentially if you live now you add 65, that's actually 10 years, so not 15 years. Right? To say if you live from 65 to 75, assuming you may know that you're going to die at 75, or you might have decided that, listen, the life expectancy at 65 is now 75. So I'm just going to
but I mean, it's not even about that. It's about we are analyzing a person who has lived up until 75. So it's like we know the model, and we know when they started to withdraw their retirement salary or whatever, right?
Yes. Yes. And what I'm saying is, let me see, divide by 10. That's per year, right?
That's per year.
Yes, that's per year, right?
So they basically have 97,000 per year at their disposal.
Yes. Whereas with the retirement annuity, they've got 248,000 per year at their disposal. This is pre-tax.
And then after tax?
After tax, let me just look at the tax tables. Oh, actually, it works out close enough that it's going to be roughly taxed at 18%. So I can just say that times 0.82. After tax, it's 203,000. Let me actually do that. So equals that times 0.82 so that we can see both. Right? So what we're saying is that they can draw 97,920 up to the age of 75. Whereas with this one, up to the age of 75, they will have drawn 2.4 million, which is roughly 203,000 after tax, right?
Now, what I'm saying is, yes, I see the numbers. Now, what I'm saying is, why is it not an advantage to have both? Because actually, majority of the population usually do both.
Would have both. Okay. Yes.
I don't know, because that 97,000 you can actually take and start to invest it into your RA or however it works.
Yeah.
And but I mean that I don't know if that would be profitable because it's still going to be taxed and stuff. Or when you are withdrawing your 203, at the same time you are withdrawing 97,000. So in actual fact, you have 203,000 plus 97,000 after retirement at your disposal.
Okay, let me answer one question.
Plus the fact that what happens to the RA after you die?
It goes to your spouse and your family, your beneficiaries.
Exactly. So now we're saying that you have your retirement annuity and your death benefit going to your spouse and your loved ones and blah, blah. And also you have, the unfortunate part is maybe you don't live until retirement. So maybe you don't get to spend this 203 and it goes to your spouse because you die before you retire. As I understand, you start spending this money after retirement. Is that true?
Yes, correct.
Whereas in the life insurance, the whole life insurance, you are actually spending the cash value, the accumulation, while you're still alive. You don't have to wait till retirement. You don't have to, there is no limit to when you can spend your money. So let's just say you decide to spend it after 40 years. Yes, there's going to be this comparison because I guess now you're 60. When did we say we're retiring?
65.
Okay, now you're 65,
Yeah.
and you're cashing out this 203, and in the life insurance you're cashing out that 97. But let's just say now you don't make it till the 65.
Yes.
Let's say you die at 60.
Okay, let's put in the die at 60. Right?
Yeah, or maybe 56 or whatever, right? Just an age before retirement. It's interesting to see what the cash value returns, the accumulated money, is going to be. And the more interesting part for me is the fact that you are going to be spending this money while you're still alive. There still is that portion of your money, which is the policy, the death benefit, that is going to go to your loved ones. So they're covered, they're taken care of, you've sorted them out, right? And then there's this money that you can spend now to pay off your loan at the bank, your mortgage stuff, to pay for your children at school, to pay for your medical aid, and so on and so forth. Yeah. Now.
So, okay, let me take one question at a time, right? So the first one is, why can't you do both, right? And the simple reason in this case why we were not doing both was because it's for comparison purposes. We first wanted to see which one yields the most benefit, right? And then now, when you say, why don't you do both? As you are 100% correct, most people are doing both. You've got life cover and you've got a retirement annuity, right?
You know why I'm asking, why can't you do both? Firstly, because I see it more profitable. But secondly, is it realistically possible here in South Africa that people do both, considering the salaries that they make, the money they make? Is it realistically possible for them to be paying premiums for a majority of accounts?
The statistics say no. The statistics say the average person is not in a position to be able to retire, meaning that the average person is saying, I can't afford to save for retirement, and or I anticipate that I will die before retirement age, therefore therefore they are unprepared for retirement.
That's even now a more interesting case, because is it a lack of knowledge thing that they see it like that? Because I've seen like 75% of South Africans, for example, this is on a different case, don't see the need for a will. A will now is out a bit outside. They don't see the need for a will. So a lot of people probably die without wills. And then there's this like confusion and stressfulness over their assets. You find families fighting and so on. But that's another story.
I was about to say, that's another conversation altogether. Actually,
that's another.
I have a lawyer friend who I'm due to record Deceased Estates with, and that's an entire.
Because I'm kind of curious if it's a lack of knowledge. Like I don't know how the financial.
I think it is. It's number one, a lack of knowledge, right? But number two, I think it's even with the knowledge, two things actually. It's a lack of appreciation of what the numbers look like. So it doesn't really resonate what is actually going to happen, right? And number two, over and above that, it's, I suppose, just insufficient income. So you don't have enough money to be the perfect citizen that has got both life insurance and retirement annuity. And I think to your point, right, I want to discuss this dies at 60 scenario, right? My understanding is that with insurance, by the time they calculate your premium, they would have taken into account all the information that you gave them and then looked at the actuarial tables and come up with a likely
Yes,
which is not
100% likely.
Yes, and
it's a forecast.
Yes, but they invest top dollar in making sure that that forecast is as accurate as possible. Yes, and even when they get it wrong, so for example, when you die at 60, my hypothesis is you probably would have not disclosed something. And the first thing that I understand insurance companies would do if you die at 60, the minute they get notification of your death, they then would try and see how can they void the insurance contract and then enter into a settlement with your family to say, listen, we actually asked for the post-mortem and it shows that your dad or your grandfather had pneumonia. That means that actually he did not disclose that to us so that we can adjust his premiums or his death benefit. And therefore, it may seem as if we didn't insure him in good faith because he didn't disclose in good faith, which is a very emotional discussion. And they're likely to say, as a settlement agreement, we will pay you out, let's say 3 million and not 5 million.
But unfortunately, a contract is signed, isn't it? And during settlement, we are following the contract, not the undisclosed information that the insurance company missed. Because if they did miss some undisclosed information and it's not in the contract that should be considered, then it's their loss.
But remember, the first thing that an insurance contract would say is that you have a duty to disclose. Otherwise, the contract is not in good faith.
But then it's inaccurate to say that this person didn't disclose, because you'll find that this was the issue of hospitals, for example. Let's say they didn't go to the fancy hospitals and they went to government hospitals, so they didn't even know they had pneumonia at the time of death. So what is there to disclose? So
one of two things. I don't want to bash government hospitals because that's again another conversation on its own.
It's just an example. We're not bashing you. You're in a private hospital and they gave false information, right? Let's just say you had that one doctor who didn't take the matter to the extent they were supposed to take it to. So the patient at the end of the day doesn't even know they have pneumonia. And at the time of death, they don't even know probably why they were sick. They know they were sick, but nobody knows what was really happening, you know? So at the end of the day, there's no disclosure because there's no knowledge of what exactly is wrong with me, right?
Yeah. So
what happened
again, and we're seeing this a lot with Discovery, for example, where they essentially have gamified the game of the business of insurance, i.e., they will try and push you to go for certain checkups that will make sure that they are made aware of certain illnesses that you may have or not. Create a situation where it's difficult to argue ignorance, right? So the situation of non-disclosure, the likelihood of it being a good faith non-disclosure decreases more and more. In the event that the doctor kept the information from the patient, then the insurance company then has a claim against the doctor and they will still pay out the 5 million rand claim, right? Because you know what I'm trying to do? I'm trying to falsify. So I'm trying to ask myself with all your questions.
Yeah.
The business of insurance has to work for the insurer. There is no way that they enter into a bad deal having had all the information as well as all the actuaries to calculate to draw up the underwriting contract. And that's what I'm saying. When you take out insurance, you're coming up against someone who's in the business of calculating risk better than you are at processing the emotional thought of you dying.
I hear what you're saying.
Yeah.
I mean, you are coming up against someone who is analyzing risk better than you, but
Yes.
you are hoping that this person is analyzing risk better than you at your interest as well somehow, right?
Yes.
Because
Yes.
now it's going to bring us to this part of what happens if I die at 60. Because
Yes.
before I leave, I want us to have compared the advantages of the RA.
Yes.
And now I would like us to consider a case whereby I do not reach my retirement age, meaning I
Yes.
cannot make withdrawals under the RA, meaning
You
those.
can. So you don't
You said I
forfeit.
can only make them.
Yeah. You can
You said I
only
can
make.
only.
It's actually at 55. I just use 65 because I want to make it comparable to the insurance contract. And I had started the calculations before we got online just to save us some time. But essentially, this would be 55, you name it.
What
But,
about 45? My point that I want to get to is what happens if I die before retirement? Because with the RA, I'm gonna make the withdrawals after I retire, correct?
Let me do this. So the rule of retirement of RAs is the earlier of 55 or death. So at death, this goes to your family. If death is before 55, and at 55, you then start withdrawing the 4%. That's just the global rule, yeah. So with an RA, it's straightforward. If you die before the time, then whatever is there is an asset that belongs to your family.
So why can't I just now have both? Okay, not even both, but why would I prefer to have the RA over the life insurance? Because 5 million is guaranteed going to my family. Doesn't matter when I die.
Because no. This is what I'm saying.
Let's ignore now the underlying factors, because I'm very sure that there are also underlying factors in the RA that we're not considering. Let's just say now it's a normal case scenario where both I'm healthy. Let's say it's me.
Yeah.
I'm healthy. There's nothing wrong. Like I've disclosed everything I need to disclose to the life insurance, and the contract is okay. So now, why would I prefer to have this RA, as healthy as I am, right? That is going to cash out 6 million to my family, but I'm not spending any money while I'm still alive, over cashing out 5 million to my family, and I still have this cash value that I'm using to aid situations, my debts and so on and so forth, take loans, pay for my children's school fees and so on and so forth.
The actuarial calculations are correct, and you died before 65, and there was no non-disclosure, it's likely that there was negligence involved.
What do you mean there's no non-disclosure?
So you said, let's not
said I'm healthy.
Yes, you healthy.
I said I'm healthy. So in this case, I'm complying with all the necessary rules or duties that I need to comply with for the life insurance, right? Yes. I'm also complying with all the rules and the necessary duties that I need to comply with the retirement annuity, right?
Yeah. Then
the difference is $1 million, and the huge difference. The difference is $1 million over the benefit that my loved ones are going to get. But the hugest benefit is the fact that while I'm still alive, because I mean, the death benefit in the life insurance, contract deducts any loans or any blah blah I had, any debt I had before now settling my loved ones. Is it the same situation with the retirement annuity?
So the retirement annuity will give your loved ones their asset. And then
what happens to my bank loans that were not paid and all my debts?
They go settle them, right?
Okay, so it's the concept. It's just that now it's not them doing it, right? But then like my point is that now let's just say I have these loans. They keep accumulating with this retirement annuity, whereas with the life insurance, I'm able to settle some of them with
while
this
you're alive.
accumulated cash value while I'm alive.
I hear what you're saying. I hear what you're saying. So here's what I need you to appreciate, right? No. Check this out, nah. In the
Okay,
event,
see.
so I've made all of this green, meaning that you've got a good faith death, right?
Mm-hmm.
It either means that the insurance company was wrong, then they lose. They pay out 5 million and insurance has worked out, and your family, essentially your family benefited to the value of, let's say, an extra million or two over the retirement annuity, right? Now it's a game of probabilities because insurance.
That is why I said,
yeah.
Sorry to interrupt you.
Remember, insurance, they actually are in the business of pricing your risk. So it's unlikely that you will have a good faith death before 65. It's either
But it's
if you,
also likely. But it's also likely. You understand?
but this
It is a probability game.
No.
Yeah.
Okay. If you died before 65, how would you have
Yeah.
died? It's either somebody would have murdered you. But murder.
But wait, like I could have a car crash or something similar. Like there are a whole lot of things. I could be sick, right?
But if you're sick, you disclose it. If you're sick, you disclose it, and then your premium changes.
No, hold on. I could be sick. Let's just say I had food poisoning that is fatal. There's no time for disclosure. I could choke on a bone. There are a whole lot of ways I could die, right?
And
it is
I'm
a
probability.
Yeah.
So
it is a probability factor. So it's not wise for us to consider probability. And it's not impossible as well.
Yes, it's not impossible, but insurance takes that risk, right? But it's not a naked risk. It's a well-informed risk because, to your point, in the event that you don't die of the things that you would have disclosed and they calculated your premium on, then that's why I want to tap into negligence, right? If you die in a car crash, most car accidents are as a result of being under the influence of alcohol, or the other person is under the influence, or you are not wearing a seatbelt, for example, right? Or the airbag didn't deploy, which means that your car was faulty, which is still negligence, right? And you go through that list of probable deaths, and by the time you get to choking on a bone, that is so specific that either the insurance will just take the loss, or the insurance would have had a catch-all phrase to say, and I think that's what was happening for a long time in the insurance industry, where they actually would say, when we talk about death from chronic illnesses, these are the chronic illnesses that we are speaking about, and these are the illnesses that we exclude.
Yeah.
You know? So there would be some sort of catch-all phrase. Ultimately, if you have the perfect example, then, as I say, insurance as a business would be failing, and you get your payout, and it works as it says on the sticker. But we're not seeing that. The biggest finance companies in the world are insurance companies and asset managers. Insurance companies, the only way they're becoming as big as they are should be because they're paying out less than they had calculated they would need to pay out.
Or their investments are paying in more than they had calculated to be paying in. You see, it's a thing. So we can't ignore these factors. But at the time,
which is this situation. So insurance would then be, and I'm hoping this is the last highlighting, this is the ideal situation for insurance. So you can, let me say retirement annuity and put investment, right? Because all that retirement annuity is your money going into an investment. It just so happens that in this case, you're doing it yourself, but anyway, your insurance is going to take your premiums and also invest them in the same stock market that retirement annuities are investing their money, right? And in this case, where you die at 65, then insurance would have made a net profit of $1 million. You would have got your 5 million, and everybody walks away happy.
Yeah, it's a win-win.
It's a win-win situation. And ideally, that's how insurance is supposed to work. But do you see how small a target you're aiming for? Because the minute you live a day beyond 65, they're now starting to win.
But then you're also winning. It's just that now you have to consider factors of you not disclosing and so on. So it would be also an interesting thing to know. With the investment, this retirement annuity. When they consider it a non-payable scenario, because, for example, the insurance company now is saying that if you didn't disclose an illness, it's not part of our contract, so we cannot pay this policy. What about the retirement annuity? Do they have such cases? Because it would also be interesting to disclose them.
Because in their case, it's not a risk contract. It's literally an investment vehicle. It's literally we are going to take your money and we're going to invest it according to the pension fund regulations. So you 100% exposed to the risk that inflation is 9%.
And then what happened? Yes, inflation and taxes. I wanted to get into that, but it's a very long topic now, because I do believe that inflation and taxes are going to affect this retirement annuity. And as I was speaking to you before, we also have things like the market volatility, right? The economy can change in a second. Then how do you find these type of investment, because it's an investment, right? How are they reliable when the market has crashed? Considering things like I was telling you about the US with the RIA. It's a traditional thing. There are systematic withdrawals that you would be making, right? Let's say in a space of 40 years. And then we look at what happened in the US in 2008. You remember there was an economic crisis. If you are making those systematic withdrawals, let's just say your retirement annuity was sitting at $1.5 million. Actually, considering that crash, you could have been close to losing your money to something like 215,000. From 1.5 to 215, that's a big hit. Whereas if you had the life insurance, you are just really unaffected.
So what you'll see happens, right, inside
the same disadvantage of lack of disclosure with the insurance company that is probable, like you said, is going to be the same situation here, because who predicts a pandemic, for example, and a war and stuff like that? You know what I mean? And then now I have retirement annuity and I'm taking this huge hit.
So what you'll see is these common terms, right? And I have 1 minute. At 25, your retirement annuity house or company will most likely be 75% in shares and 25% in bonds, meaning that if a crash happens, you still have time to recover. And since you're still contributing to your retirement annuity, you're actually buying more investments at a lower price, right? Then the closer you get to 65, you will find a situation where the ratio has flipped, and you essentially have a situation where, for their risk management purposes and because of regulation, they're sitting more or less in that type of scenario where it's 75% bonds and 25% cash, meaning that less money is in riskier assets the closer to retirement you get, reducing the likelihood that a market crashes at time of retirement. No.